Hi everyone, welcome back to Be Rich. It's me, Vinod, here with Anand, and we have an interesting conversation lined up for you. This bubble which we see, which in the stock market, is not only in the stock market, it's very much apparent there in the credit market too. The gap between US companies' borrowing cost and the US Treasury yields has shrunk us to its smallest since 1988. That's the last century, if you look at it. And this hot rally seems to be completely fueled by this so-called easing of trade tensions. But there is nothing that should give this kind of confidence in the market, right, Anand?
See, what it clearly shows is, for me, that there is a lot of liquidity sloshing around the market. I won't say trading curbs and all have not made the difference. This is the liquidity problem. The Fed wants to keep interest rates higher. That's between 4.25 to 4.5. Corporate loans are available at 5.25 to 5.5. This means that the gap between what the Fed rate or the Treasury rate and corporate rates have shrunk. So, which means there's so much liquidity in the market that the corporates are able to borrow at a rate almost similar to what the United States government is willing to borrow.
Yes, usually the gap is wider.
The gap is wider. So, for the amount of risk they take, the difference between a sovereign risk and a corporate risk, the gap has to be higher for me to take a risk. In this case, the risk is extremely low. And because the extreme of the risk is low, what everybody feels, and I also feel, is the market is taking it too easy. Why is that happening? Because when they did kept buying government and corporate bonds,
Yes, quantitative easing.
when they did quantitative easing, they bought a humongous amount of bonds.
Yes.
Okay, then they stopped. Then when the Fed started to tighten, it did two things. One is that it increased interest rates. And the other thing it did is it said that when bonds met, they won't sell American bonds or corporate bonds. When the bonds rematured, they would not buy back bonds.
Correct. They let it go out.
They will allow it to taper at a particular speed. When that started to happen, two banks collapsed.
Yes.
Yes, the most famous thing is the Silicon Valley Bank collapsed. And before that, another bank collapsed. When two banks collapsed,
Government panicked.
the Federal Reserve panicked and said they would reduce the taper amount to a lower level, and or they finally abandoned the taper amount.
But also the Biden government stood behind the banks, right? Saying we're
It was the Federal Reserve it stood bank and
okay.
said that we will repay all depositors
Correct.
by forcing a shotgun merger with a stronger bank. Okay, there was a shotgun merger with a stronger bank. So basically, what the Fed said is this is the rate. At this rate, we will slash you with credit, with money. Since if the Fed had allowed the taper to continue, lesser money and more
More
bonds
bonds will
will
be
be
available.
available,
Correct.
and more money would have come to the Fed, and Fed would have extinguished that money. Instead, the Fed allowed a greater amount of money to slosh around the system.
Correct.
So, which means because there is plenty of money and there's only so much treasury you can buy, the rate between corporate loans and treasury loans has collapsed. And you are able to borrow, big companies are able to borrow almost at sovereign rates.
Correct.
This is highly unusual. Normally, in a tightening cycle, you expect that interest rate gap between corporates and the
Fed.
Fed to be
Much wider.
much wider. Also, whether you like it or not, all tariffs have gone up, and they have gone up only on August 8th. Already, people are celebrating that inflation has not gone up
Correct.
dramatically. But for inflation to show up will take December because he has finally increased some tariff to 15% only on August 8th. So it has to flow through the system. And once it flows, it's already showing up in several places. So inflation has begun to go up.
And job numbers are also not great.
Job numbers are not great. And also, what is going to happen is you are going to have contraction of growth. So, if inflation goes up, which is what the Fed is worried. If inflation goes up, then the Fed will not be in a position to cut. That is, Scott Bessent is now telling the Fed that you have to cut the rate to 0.5%
Correct.
by 0.5%. I think under pressure, Jerome Powell may cut it by 0.25 because he waited for a long time for inflation to show up. It didn't show up at the level at which he expected it to show up. So he will cut it at 0.25 and wait for another 30 days for it to show up. I'm sure it will show up. Even if it doesn't, there will be another 0.25 cut. So 4.25 to 4.5 may become either 4 to 4.25 or 3.75 to 4. That is not going to make a significant difference to the economy. With corporate alerts being so low,
Correct.
it could also mean, while I said it is liquidity sloshing, it also means that the credit bond market is expecting or already fact that credit rates are
The
going to
Fed
go
is going to
down.
cut the rates. Yeah.
So if the Fed cuts rate, I don't think corporate bond yields will fall. Even if they cut 0.5, maybe the corporate rates will fall by 0.25. If the Fed holds this for the entire year,
Then
and
corporate rates, you do
the
feel.
corporate rates will go up.
Okay.
So what the corporate rates are telling us are two things. One, there is a lot of liquidity. Another, there is a rate cut expected anytime because of two reasons, or three reasons. One is definitely that the American economy is slowing down. Two, that there is enormous political pressure. And three, there is liquidity sloshing around and labor market is down. So your growth rates are down, liquidity is sloshing around, and third, your labor numbers are also stretched. So with all this and inflation not really going to 3.5 to 4, the Fed may cut. That is what this is signaling.
Yes, because even if you look at the bond market for emerging markets, the news is the banks and companies in emerging markets outside China are selling international bonds this year at a fastest rate since 2021, as premium investors' demand to their own debt over US Treasury has fallen to the lowest since 2007. So this is further fueling the idea that what you're saying.
Yes, so what is not, it's not only US corporates. Something like an HDFC Bank or a State Bank of India is able to sell at a very low premium compared to 2007 simply because they are wanting to take the risk. The
But the,
risk is taken because I said again the same thing. Since growth is petering out, labor numbers are falling, the Fed will be forced to cut rates. Inflation has not shot up, it is going up but not shot up. This will force the Fed's hand and cut rate 2-3 times this year. If the Fed cuts 2-3 times, this band will normally adjust.
correct.
If there is no rate cut, the bond rates have to go up. There's no choice.
Okay. And this shows further that wherever we are, there is really no happy news. No matter what people think about the trade tensions easing or whatever.
I don't think the trade tensions have increased. With Mexico and Canada, he is playing hardball.
Correct.
So I don't see, but these are the biggest trading partners. Japan, yes, 15%, Japan, but it will make the US auto industry uncompetitive.
Yeah, they've already been complaining.
Yeah, so it is a very crazy thing. We have to wait for the world things to unfold before us
Yeah,
before this happens.
correct.
And then there is an artificial intelligence boom where people are investing money.
Correct.
And because the spreads are so thin, people are now borrowing money to blow it on artificial intelligence.
True.
Whether artificial intelligence will make that kind of
Returns.
return on investment, I don't know.
Correct. So there you go. This is what I wanted to share with you. There are some warning signs even in the credit market, which looks rather interesting if you're paying attention to it. And no one better to explain this to us than Anand. So I hope you enjoy the video. I hope you found it informative and entertaining as always. Nothing else more to say than wishing you a great evening from us in Chennai. Good evening.
Thank you for watching, Birich.